Be honest with yourself for a second. When a major economic report like CPI, NFP, or an FOMC rate decision drops, do you actually trade the news, or are you just gambling on it? Look, we all know the feeling. The clock strikes the release time, you're glued to Bitcoin or gold, the chart goes absolutely crazy, and suddenly you're either making a fortune or blowing your entire account in 30 seconds flat. Well, today's explainer is all about conquering that sudden, extreme market volatility. We're going to dive into proven strategies to help you stop guessing and start executing with total precision during these major data releases.
Here's our roadmap for today. We'll cover the high-impact news trap, pre-news chart structuring, the step-by-step strategy, surviving the initial spike, and we will wrap it all up with risk management and psychology. Let's get right into it.
All right, part 1, the high-impact news trap. There is a stark contrast in mindset when the news hits. On one side, we have the typical amateur approach. The gambler operates entirely out of FOMO. They see a giant, ridiculously fast-moving green candle on gold during an NFP release, their heart starts racing, and they just hit buy, hoping to catch a ride. They're essentially throwing darts blindfolded, guessing the market direction based on pure adrenaline. But on the flip side, we have the pro. The professional's approach is entirely structured. They are patiently waiting for structural confirmation to form, and most importantly, they remain completely emotionless. They honestly don't care how fast that candle is moving. They only care if their specific setup criteria are met. Now, you might be wondering why that first candle is so dangerous. It comes down to liquidity sweeps. A liquidity sweep is basically the market's way of finding the fuel it needs to make a real, sustained move. That very first, incredibly fast impulse candle you see right when the news drops, yeah, it's almost always a trap. Imagine a sudden CPI release causing a massive downward wick on Bitcoin. That drop is specifically designed to hunt stop losses and trap early sellers who are going the wrong way before aggressively rocketing upward. If you're chasing that first candle, you are literally just becoming liquidity for the professionals.
Moving right along to part 2, pre-news chart structuring.
So multi-time frame analysis is an absolute necessity for news trading. You cannot just stare at a 1-minute chart of Bitcoin right as the news drops and expect to survive the chop. Your major zones, the real battlegrounds of support and resistance, must be plotted out on higher time frames, like the daily or 4-hour charts, to identify the overarching trend. Then, and only then, do you zoom down to the lower time frames to pinpoint your precise entry points and wait for the market structure to actually confirm your thesis.
I really cannot emphasize this enough. You must structure the trade before the news hits, period. Explicitly identifying liquidity buildup and pre-news consolidation ranges in advance is the absolute foundation of a profitable, emotionless strategy. Because think about it, if you wait until the extreme volatility starts to try and figure out where the market might bounce, you're already too late.
So how do we actually execute this? That brings us to part 3, the step-by-step strategy.
This is the exact sequence that shifts you from wildly gambling to executing a highly structured, repeatable process. First, identify the exact timing of the news. You need to know down to the minute when that FOMC data drops. Second, mark your consolidation ranges and liquidity zones. Third, and this is where almost all amateurs fail, wait out that first impulse. Let the fakeouts and liquidity grabs happen without you. Do not trade that initial reaction. And finally, step 4. Enter only on structural confirmation. You can never ever skip directly to step 4. If you don't wait out that first fakeout, you're just gambling.
Which leads us perfectly into part 4, surviving the initial spike. Take the number 1.9 for example. That represents a 1.9 R profit multiple from a live trade breakdown by Mariana over at Urban Forex. During a highly volatile news event, she achieved this exact profit multiple specifically by not panicking during the initial chaotic print. She didn't jump in early. She watched the violent spike happen, maintained total psychological discipline, let her pre-planned structure form, and only then did she pull the trigger.
Let's break down the mechanics of why waiting is mandatory. Right before a major event like an FOMC decision, major liquidity providers actually pull their orders from the market. Because of this, spreads widen drastically. The gap between the bid and ask price absolutely explodes, meaning if you enter right then, you're instantly starting the trade heavily in the red. Combine that with the fact that the first impulse is almost always a trap as the market violently hunts for liquidity, and you can easily see how early entrants get completely destroyed by slippage and wide spreads.
I love this guiding principle. Approach trading during news with structure instead of emotion. Waiting for a clear retest of a broken structure after the initial chaos has settled is what ultimately separates the consistent winners from the gamblers.
Structure keeps you safe, emotion gets you liquidated.
Finally, the piece that holds the whole system together. Part 5. Risk Management and Psychology. Let's rapid-fire the strict risk protocols required to survive these events. First, reduce your position size. Second, use wider stop losses. These two literally go hand in hand because an asset like gold can easily swing $20 in a matter of seconds during an NFP release. You need a much smaller size and wider stops just to give your trade room to breathe without getting prematurely wicked out. Third, brutally control your FOMO. And fourth, simply stay out if the conditions are unclear. Honestly, this right here represents the ultimate level of trading maturity. Not trading is a valid trading strategy. Sometimes the CPI drops, the chart becomes an absolute mess, the structure is totally broken, and there is just no clean entry. It requires immense mental fortitude to watch an explosive continuation move happen without you, simply because your specific setup didn't trigger cleanly. But protecting your capital by doing nothing, that is a massive win. As we wrap up this explainer, I want to leave you with a crucial reflection. Knowing what you know now about drastically widening spreads, massive liquidity grabs, and violent FOMC fakeouts on assets like Bitcoin and gold, do you actually want to trade the news, or does it make more sense for your specific strategy to just stay out completely until the dust settles? Take a hard look at your trading rules, refine your strategy, and decide what kind of trader you really want to be when the market goes absolutely wild.